this morning in Asia, trading above $113 a barrel. Quite a steep recovery in the last week. Let's kick off this morning with Kate Durian, Mies contributing editor and non-resident fellow at the Arab Gulf States Institute in Washington. Kate, is there anything now that can stop this oil price?
I mean, at the moment, we've seen releases from emergency stocks by the US, the IEA, OPEC gradually increasing production, and nothing really seems to stop this sort of bullishness that's taken over. You've got outages from Libya, and I suppose if you look at the numbers, OPEC is not producing, or the OPEC Plus are not producing as much as their target. So, and that has been increasing, as they've unwound these cuts, and it's become obvious that certain countries just can't produce. And the market was tight going into the war in Ukraine. And so it sort of exacerbated what was already a structurally weak market on the supply side. Now, demand forecasts are being downgraded slightly. Russian outages have not been as great as people thought at the beginning. So at some point, maybe markets will balance, but you're going into a higher demand season for things like gasoline. People are traveling again, but you have lockdowns in China. So, there's this sort of tug between the two sides. So I think we're in for a sort of a high price scenario for quite some time to come.
Let's welcome Randall Mohammed, Managing Director of Petrol Industrial USA, sitting in Florida. Randall, we did seem to have a tug of war between the supply concerns, bulls, if you like, predominated by possible Russian disruption, versus the demand destruction worries of China and COVID lockdown. It would appear that the supply concerns have won the tug of war for Q2. Your thoughts?
Hi, good morning, Sean. Yes, look, exactly. I agree that it is this tug of war happening. But I think the rebound in prices really is attributable to the fact that China seems to be opening back up. There's news coming out of China that factories, are getting back into production. So that seems to be calming the demand side of the equation. And I agree that Libya is probably still trying to recover as well. But I think we're going to see this tug of war continue. And I think it'll get even worse as we see the war continue. The forecast is if this war really progresses, we could see between 1 and 3 million barrels per day of Russian crude come off the market. So, Sean, I think it's going to get worse before it gets better.
Let's welcome Osama Rizvi, energy and economic analyst, Primary Vision Network, sitting in Pakistan. Osama, I suppose for countries like Pakistan, whether it's $110 or $100 on Brent, it's still far too much and still putting incredible stress on emerging economies with inflation and all sorts of other challenges.
Absolutely. If you talk about Pakistan, so inflation levels in Pakistan are expected to touch 15% by summer, which is the same as that of Sri Lanka, right? And Pakistan imports 60% of its energy needs. Of our import bill, 30% is that of oil. So it's not only and it's not only the oil prices. You see, we should also be looking at, when we talk about emerging markets, we should also be looking at the dollar. So the dollar index is at its highest in 2 years. It's now at 100 something, and that and I've written about it as well. And that puts double pressure on countries like us because we have a lot of debt. Recently, I was reading of all the debt accumulated after COVID, especially after 2021. up until now, 80% came from the emerging markets. It stands now, global debt, it stands somewhere around $315 trillion, right? So, and we have to service this debt, of course, in dollars. So it's very concerning.
Well, yesterday the IMF put out a warning that emerging market banks, government debt holdings are looking very vulnerable. It's sort of the major, this is the spring meeting in Washington, D.C. And today we are going to have the IMF's report, the Global Financial Stability Report. The top headline is going to basically be, there's a lot of stress in emerging market banks.
Absolutely. State Bank of Pakistan increased its interest rate in one day by 250 basis points. From 9.7, we went to 12.25%, just in one day, as an intervention against a falling rupee and a rising dollar. But I would like to very briefly comment on the oil prices as well, regarding the bullish and bearish side, if you allow me.
Please.
Yeah, so the way I see it, there have been two significant developments that I believe will, the consequences of which will be seen or felt in the markets in the coming weeks or months. One is the, resurgence, or you can say rekindling of interest by Finland and Sweden to join NATO, and this has put new stakes into the Russia-Ukrainian conflict. And the second one is the EU ban on oil, on Russian oil, right? So, and I believe
neither of which have happened yet, right?
Yeah, and I personally believe the second one, the EU banning Russian oil, it's not possible actually in practice. In theory, there are alternatives like OPEC, Algeria, Libya, Venezuela, Iran, but we know what's happening in Venezuela, right? There's already civil strife. There's already damage to infrastructure. They can't fill up. OPEC, according to one estimate, if they increase their production to their maximum levels, they can only replace 2 million barrels per day out of the 5 million barrels per day that Russia supplies to the EU. So there's still a gap of 3 million. So practically this can't happen. What I was trying to say is that these are the bullish factors, but there are bearish factors as well. I believe if there is a successful Iranian deal, right? And if it happens at the time when there is a de-escalation or even a hint of it going on in the Russian-Ukrainian conflict, I believe not only oil prices will fall, they can crash by $20-30. I fundamentally believe this, because this is seen when
I suppose there's a lot of ifs stacked up on top of each other there. Kate, what is a confirmed fact is that in the last few days, the Russian president seems to be doing a phone call arounds with OPEC plus countries, obviously most notably Saudi Arabia over the weekend, but yesterday with Algeria. Mm-hmm. What does that tell you about what is obviously the geopolitical diplomacy of OPEC plus?
Well, the geopolitical diplomacy of OPEC plus is set by Russia and Saudi Arabia. So I can't see any of the OPEC producers going against the Saudi stance toward Moscow. And, so far, all we've heard is, that relationship is there to stay. We leave politics at the door. But of course, the decision was not political, because if you look at it, if you look at the market balance, the least OPEC plus could have done was replace the oil that some of its members have not been able to produce, at their quotas, and they haven't done that. So to say that fundamentals don't really have a role in their decision, I think is a bit, is fudging the issue, to say the least. But things are opening up again. If with China, it's not just the lockdowns; it's also the economic growth in China, and spending power. So you've got the inflationary pressures, you've got stagflation threats here in the UK, for example, and high gasoline prices. So I think that will sort of dampen demand over time.
If you look, just coming back to the point of, just wanted to drill a little bit further into this, of all of the 22 countries one could have made a phone call to from Putin, he phoned Algeria, who just happened to be the one taking some of their market share for gas in Italy. I'm just wondering what are your thoughts about the potential for how, this technocratic OPEC plus getting dragged into this vortex of competition and this new sort of order?
I mean, yes, Algeria can supply a little bit more gas, but not by much. I mean, when you look at the size of the European markets, and we're just talking Italy, which already is the biggest investor in Algeria, ENI, there is a gas pipeline already existing. The only other option is to go through Spain, which is no use because you've got limited pipeline capacity with the pipeline through Morocco closed at the moment. And even if it got to Spain, the chance of it going further north is quite limited. So I think that maybe, yes, I mean, we don't know the contents of the conversation, but it may have been a sort of maybe a warning to Algeria not to supply. But again, gas prices, natural gas prices are record high, so it's going to follow the money. Any gas seller is going to follow the money.
Every one of them is going to make a fortune regardless. Randall, speaking of tug of wars, trying to get a handle on the health of the U.S. economy, we've got practically record employment, near full employment. Stock markets seem to be unwilling to budge from their near record highs. And yet there seems to be a sort of a crisis emerging potentially in the US, i.e. that we're about to go to a cliff rather than a slope down into a gentle valley. How do you read the economic outlook in the US at the moment?
Yeah, absolutely, Sean. That's correct. And the inflation factor is one of the biggest things that the Fed is dealing with. We're facing, record high inflation rates. We were up to, just about 8.5%, I believe, at the end of March. And, the Fed has now signaled that they may hike interest rates by 50 basis points in their next meeting. My forecast originally was that they would have stuck to the 25 basis points over a period of 7 periods. But it seems as though the Fed is now being pushed into a corner, and Powell is being forced to act. And by acting means he's going to push up the Fed fund rate to 50 basis points. Now, of course, it's a balancing act, right? You have recovery on one hand, and you have the risk of recession in the other hand. And, a lot of the analysts have been talking about this, what we call inverse yield curve. And historically, an inverse yield curve signals recession. So look, yes, we are at near full employment. However, gasoline prices have eased somewhat. We're still well above $4 a gallon. And if you remember back in 2020, we were less than $2 a gallon. So, that's still sort of hitting Americans in their pocket.
If you take Powell and the Fed's mandate, I mean, ultimately they have a mandate to keep inflation near 2%. And obviously to keep employment as high. They have two mandates, essentially, employment and inflation. They've got employment, I suppose. You couldn't say, A star, perhaps, if you say full employment, but ultimately inflation, they're way off. And if you just take their mandate alone, they don't have a choice, right? I mean, they have a legal responsibility as contracted by the legislation of the House of Representatives to get inflation near 2%, regardless of what Jay Powell thinks might happen to the economy.
Absolutely, Sean. 2% was the target. Correctly, we are way off from that. And look, I don't see 2% really in the near future. I think it's going to be a real struggle for the Fed. to get back to that 2%. And of course, the criticism, Sean, is that the Fed probably acted too late. The Fed should have acted sooner, but then the Fed was caught between a rock and a hard place. You had the pandemic on one hand, and of course you had, the recovery from this pandemic. So it was a sort of a balancing act, so to speak. But we have to remember that the inflation is double-sided. On one hand, you had all this liquidity, all this stimulus money, all this so-called free money that came into the market. On the other hand, you had constraints with supply chains, and that still has not eased. And that's a difficult, really difficult challenge for the Fed. I don't think the Fed can do it on their own.
Which we're seeing now in China with, the supply chain getting locked up with the COVID lockdowns. Osama, I wanted to get your thoughts on this point. Inevitably, as we go into a tightening cycle, an accelerated tightening cycle, with rates going up, the dollar getting stronger, this is a perfect storm for emerging economies. How long can they hold here? We've seen Sri Lanka fall. What's the next shoe going to fall in this sort of global picture, and the consequences of that from the point of view of outlook for energy demand in Asia?
Yes, that's very interesting because as we have discussed before, emerging markets and developing economies, as they're called, EMDEs, they're really vulnerable to rising inflation. And if we are going to discuss food prices as well, Pakistan, the country I'm sitting right now, there was a scoreboard by Bloomberg recently that put Pakistan on the second number. In case if food prices rise, Pakistan is vulnerable. It's one of the most vulnerable countries. And I believe it's the dollar, it's the inflation, and then it is the events in Russia, Ukraine, the crisis going on, and that feeds into the loop of the food prices. And we have a perfect recipe. I don't want to sound all the doom and gloom scenario type, but that's a perfect recipe. It's not a matter of if, it's a matter of when things will go south very steeply. I've told you about Pakistan. I was reading about Nepal. It is not as bad as Sri Lanka, but Nepal is also facing some crisis. It's a liquidity crisis, right? India, of course, is one of the largest economies of the world. However, their reserves fell by $11 billion in 1 week. So relatively, that was also a huge amount. You would talk about, if you look at Latin America, we all know that there is an state of emergency imposed in Peru at the moment. Protesters are out, protesting about inflation. So if you talk about Africa, Ghana, Ethiopia, and other countries are also feeling the pain of inflation, rising inflation. So it's happening as we speak. Although technically we're not in a recession, two consecutive quarters with a negative growth, but I still believe there are pockets around the world, especially in the global south, in emerging markets, that are living in a recession right now.
Osama, in terms of that, we saw Imran Khan removed from office last week, blaming the West, blaming the US. From the point of view of this stress coming into the emerging economies, and this position vis-a-vis where you stand on the Ukraine war, is there a blame towards the West for this rising cost of everything?
Not really. It's not. So people here, look, the people here are confused. So when there are political commentators speaking on TV talking about how during the Imran Khan's tenure prices went up and this happened and that happened, they fail to acknowledge or account one of the greatest factors that every leader, that every country, every government in the world faced, that is the pandemic, right? The leaders before him were, no matter how much challenges they faced or encountered, they had nothing of this sort, not even close. So people now have started to get that, but the blame is not on the rising prices. They always blame the current incumbent government on the rising prices. They're not blaming the West. However, there has been a very blatant, a very explicit concern, and one may say frustration amongst the populace of Western intervention. Regarding all the conspiracy or the letter that was shared with the public and with the parliament. So that has been the case. But in terms of economics, in terms of prices, they're not blaming anyone else. They're only blaming the current government, whether it's Imran Khan and now it's Shehbaz Sharif. They only want them to fix it. It's as simple as that.
Let's get to the survey question and give everybody else in the room a chance to comment on this general position. Oil supply shortage concerns has won the wrestling match over demand destruction worries for Q2, with $110 on Brent replacing $100 as the new floor. Agree or disagree that oil supply shortage concerns has won the wrestling match over demand destruction worries, principally from China, and 110 will replace 100 as the new floor? Agree or disagree with that statement? Kate, underpinning that statement and underpinning that sort of floor, if you like, ultimately is, will they or won't they? Will the Europeans put Russian oil, on the embargo, on the next round of sanctions, which apparently reported over the weekend that it is in the mix? Your thoughts, sitting in Europe, what the appetite for that is, whether it's economically suicidal or not, ultimately where the political and social appetite to support such a policy?
I mean, Germany is going to resist very strongly. We've seen it already. I mean, they're so worried about the German economy, and I suppose for other European and EU countries. If you pull down Germany, you're going to pull down the bloc. So it's a difficult one. They have been talking about it for a while. I think if the war drags on, I mean, we've seen this new campaign that Ukraine says Russia has launched in the East. If it intensifies, then it might make it easier, but at the moment, I think it's hard. I mean, one of the problems at the moment with the market is that there isn't enough spare capacity available immediately, except maybe from two countries. You're talking UAE, you're talking Saudi Arabia. Forget about all the others. So it's really hard to see any additional volumes of both gas and oil coming online anytime soon. There may be gradual increases by the end of the year. So it's now that we're talking about. And talking about blame games, if you look at what's happening in the States, they actually, at the CPAC conference, the Republican supporters of Trump are putting the blame on Biden for the Ukraine war. For the war, they say, because he invested so much in Ukraine that this is happening. I mean, it's sort of mad. But
in terms of the European position, Kate, we have the big French election coming up over next weekend, and of course, the outcome of which could see a very different path forward for France and Europe. What are your thoughts on that, and what direction it could lead us towards on these issues, such as a unified Europe position?
Well, I mean, the polls, if you trust them, show that Macron is widening his lead over Le Pen. But the fact that she's gotten so far and is into the second round is actually very, very telling of which direction a lot of European countries are taking, and not just the likes of Hungary, but Frexit would be a huge blow. So I think it much depends on the parties that are supporting, that are putting their votes for Macron. I think he will probably squeeze past, but he will be weakened. And it is a rise of nationalism. It's anti-immigrant policy. It's a contagion. It's a Brexit contagion. Across the channel. So I think he will probably he'll squeeze through, but it's going to be difficult for him.
Of course, the parliamentary elections come very soon after the presidential. Even if he squeezes through that, he could be without a majority even in the parliament. Randall, looking ahead at politically in the US again, some thoughts for much of the last year has been that this tightness in the oil market could be saved by, or at least helped by, the lifting of sanctions on Iran and the return of the JCPOA deal. But it would appear that politically, Biden has run out of out of road there with the midterm elections now in sight. You can see them over the hill. Compromising with Iran would be very difficult at this point.
Yeah, it seems that way, Sean. As you know, midterms coming up in November. But I think there's so much happening domestically for Biden that he really has to get a grip on inflation, which is the biggest thing that is hurting the U.S. right now. Of course, oil prices and food prices are contributing to that. Now, one of the things that Biden has done recently, and you may have read about it, is that he has opened up federal waters and lands for drilling. They have now proceeded with selling leases on these lands. However, it has not been met with an uproar from the producers because he's increased the royalty rate by 50%, and he has actually shrunk the acreage being offered. And the feedback from the producers is that one, you've increased the cost for us, and secondly, you have restricted us to acreage that we don't necessarily want to drill on. So that.
But you're making so much money right now. It's hard to see. I'm sure it's a decent argument to make, but just coming back to the immediate point, regardless of that, there's no immediate relief going to be delivered by whether you're going to open up acreage or not in this current window of time, right? Oil prices are locked in, inflation is locked in. Everything, I suppose, ultimately rests with whether the Fed go into a fairly aggressive tightening cycle to try and bend the curve on inflation. There is no other tool in the toolbox, is there?
No, Sean, I think we've pretty much exhausted everything. Even the SPR. I mean, there's only so much oil we can release from the SPR. If you look at all the oil that has been released so far, that amounts to about 260 million barrels of oil. And, the SPR only has a working capacity of between 500 and 600 million barrels. So look, that's significant. So you're correct. There's not much left in the toolbox again. But I think definitely the Fed is going to look at increasing rates by 50 basis points. And the other aspect,
that's a given. It's how many times they're going to do it is the next question.
But just one more point, Sean, in that we haven't seen the full effects of it. But as you know, those Russian bonds are due to expire within the next 20 odd days, right? They've given a grace period of 30 days. And after that 30-day period, it's going to be declared as a default. Now, that's $98 billion worth of bonds, of which 21% is held by foreigners. And the pushback from the US is that, okay, no one likes to default because that hurts investors. So we're gonna grab that $600 billion that we've frozen in US bank accounts, and we're gonna use that to pay those investors. Obviously Russia has offered to pay investors in rubles, so that's not going to fly because that changes the terms and conditions of the contractual agreement. So look, we haven't fully built in the ramifications of that, but we need to look out for that as well.
It certainly seems that the knock-on effects of this Russian invasion of Ukraine, while obviously massively destructive to death and property in Ukraine, has still really to trickle out to the world. Food prices and all the other stuff was already well underway prior to Ukraine, but they now, like, not harvesting and the grain and not planting for next season, and all of these sort of longer term consequences. And if indeed Russia takes over the southern coastline of the Ukraine and changes the whole geopolitical picture of the Black Sea, I mean, these are all massive shifts that are yet to really be digested. But Osama, let's give you the last word. Get the survey results on today. Agree 110 replaces 1 as the new floor for Q2 at least. The fragility, I wanted to get your insights on with the political change. You sort of indicated maybe nothing too much changes within the context of internal domestic politics in Pakistan, but regional geopolitics for Pakistan could change quite a bit with the removal of Imran Khan. I'm just wanted to get your views on that, what it means vis-a-vis Afghanistan, vis-a-vis India, vis-a-vis the Gulf and the neighborhood.
Yes, certainly. We cannot ignore the element of human agency, right? So Imran Khan was a different person. Shehbaz Sharif, who has replaced him, is a different person, and both have different priorities apparently. And I see maybe not a lot, but somewhat thawing between India and Pakistan. There was an exchange of letter recently that diplomatic language and all that. In terms of Afghanistan, and Pakistan might become more accommodated to the US demands, right? That might happen as well. But the tricky part is Russia. That remains to be seen how we deal with that, because India is buying, despite being part of the Quad agreement, despite being well known as a Western ally, as a weight against China for the US. India is on record buying Russian oil at a 20% discount. Now they're eyeing for the coal as well, right? Because the coal has been banned by the EU. However, Pakistan is equally dependent on oil and energy imports, as I've told, but we still haven't done that, right? I'm not saying we should do it. From an energy security point, yes, but from a diplomatic point, now that everything has eventuated, all of the conspiracy and the regime change and everything, I would be personally interested to see how the policy of the current prime minister will work vis-a-vis Russia now, and the energy imperative that we have to provide low energy costs to everyone.
And will indeed India or others who the US or Europe had maybe perceived to be on their team, so to speak, have any consequences of sort of denying that partnership at this time? Or will they just, I mean, it seemed India did conform to Iranian sanctions and weren't, I mean, there was periods they picked it up but got exemptions and so on, but they weren't defiant of that. But of course, there is no global sanctions on Russian oil, and the biggest importers of Russian oil are Europe. So, one and one is two. That's not complicated. If they're doing it, we're doing it. So until that changes, one can't really expect anything else to change. We'll have to wrap it up there. Oil prices trading at $113 on Brent. It looks like they may have broken the hold on this downward motion. China supply or demand concerns possibly lifting, but of course, if indeed we do see Shanghai open up and Omicron, as we all know, because we've all lived in Omicron environments, if you have open society, Omicron spreads like wildfire. There's no way of stopping it. So if indeed they do open, what happens then? Kate, as always, thank you so much. Great to have you on. Osama, thank you for joining us. It's really great to get insights from Pakistan at this time. Randall, thanks again also from checking in from the US. A very critical period now with the months going into the election. So we look forward to getting regular updates. All the best, everybody. We'll catch up with you every morning, 10:30 UAE